This is WealthBT, a podcast of BT correspondents.
Did you hold your nerve when markets fell sharply in April, just after Trump announced steep tariffs? Shortly after markets fell, I wrote a column on strategies that could help you stay the course. Frankly, I didn't know if I'd look silly talking about things like dollar cost averaging. Many pundits said this time is different. But is this time really different? Welcome to WealthBT. I'm your host, Genevieve Cua, wealth editor of the Business Times. Every week, my colleagues and I break down a business story that matters. In the last few days, the U.S. market has been on a tear. If you'd gone away where there isn't any news access and then come back, it may seem like the sharp fall in April never happened. What exactly has changed since Trump's big tariff announcement? Tariffs are still a big overhang. Economic prospects are cloudy, the U.S. Fed may not cut rates soon, and inflation could rise. My guest in the studio is Dr. Wei Dai, Head of Research and Vice President of Dimensional Fund Advisors. Hi, Wei. Thank you for sparing some time for us.
Thanks for inviting me back.
Let's get down to it. It's safe to say that Trump's Liberation Day tariffs took most people by surprise. They affect basically every country, and it sent markets on a rough ride. Wait, how bad is the situation, really? Should investors prepare for the worst and stay in safe assets?
Yeah, as you said in the intro, it has certainly been a very interesting month. We've seen drastic policy changes, heightened market volatility, and still plenty of uncertainty unresolved. In terms of how bad it is, I think there is no doubt that trade policies can have wide consequences on the real economy. So they will impact the operations and financials of companies, but also will impact every one of us in the economy. But there is a key difference between how we feel the impact as consumers, employees, or business owners versus how we feel the impact as investors. In the real economy, the developments, whether positive or negative, they can take months or years to unfold. But in the financial market, it lets you feel the pain or joy in seconds. And that's essentially how markets work, right? The markets are instantaneously pricing in expectations about the future. So the pain you may feel now actually reflects that the market is setting prices such that the expected returns on a going forward basis should be positive. This is also why we actually saw that market returns can be positive even if the economy is bad, or vice versa. So, for example, if you look at the past 100 years, there were 16 U.S. recessions, and then 75% of the time, returns on stocks were positive 2 years after a recession began. So at Dimensional, what we've always been telling clients in Singapore and globally is that, yes, you should read the news to be an informed citizen, but don't use those headlines to inform your portfolio decisions, right? So to your point, selling after a downturn and then turning paper losses into real losses is not a great idea. I would say there's one exception, though. If the recent market swings are helping you learn something about your own risk tolerance, and you're realizing that the only portfolio you can actually stick with is the one with safer assets, then you should make those changes. But those changes should be permanent in nature. So it's a little bit like how I remind my kids, but also myself when we go to an amusement park, right? You need to know your thrill level, and then you choose the right roller coaster to be on. But once you're on, once the ride begins, you should stay in your seat, right? So it's like picking that right as allocation and then stay disciplined.
Okay, that's a very good point, in the sense that what's happening to the economy bears little resemblance to what's happening in markets today. So I wanted to ask you about patterns in financial market history. If you look back, what are patterns that you think apply today?
People say every crisis, every shock is different, right? They are different, but the role of the market is the same. So we talk about how the market's job is to process uncertainty in real time, which is why the pattern you see is that when there is a lot of new information and changing expectations, then we should expect an uptick in market volatility, and we do. Of course, volatility is not fun to go through, but I think it's good to be reminded that the volatility we're going through is a good sign of a market being well-functioning. Now, another pattern we see is that when volatility goes up, typically you see more trading volume, but also bid-offer spread widens. What does that mean? That means if you have to buy or sell certain securities in certain quantities immediately, yes, you can get the trades done, but they're going to cost you a lot in terms of that demand for liquidity and demand for immediacy. In contrast, it will be very beneficial if you have some flexibility into your portfolio design and into your daily process. And for us, because we run those strategies with thousands of names, very broadly diversified, and we use a more systematic approach to pursue higher expected returns, that means we can actually give our traders a lot of flexibility, basically that ability to walk away if the market environment is not great or if the liquidity of individual names is not there. And the end results of that is that you can actually buy at a lower price and sell at a higher price relative to others who cannot afford to have the same flexibility, whether you're talking about traditional active or pure indexing approaches. In fact, this morning, I just got the latest numbers in terms of the trade cost analysis. We saw that our price advantage went up in April, which is very consistent with what we saw previously when there were upticks in volatility, for example, COVID-19 period. So I think the takeaway for investors is that obviously you cannot control market movements, but you can control how you access the market. You can control your turnover and costs. And that is very important for having a good investment outcome.
So we started raising this question, is this time different? And it kind of feels different because of the blanket nature of the tariffs. So what are your thoughts here? Is this time different?
Yeah, I can see why people feel different, right? Because every crisis, every shock, there's definitely some unique elements. But in terms of its far-reaching nature of tariffs, there have been many other events that are very wide-spreading, right? So if you think about COVID-19, it's affecting everyone. Last time we talked about the evolutions of AI, that's going to impact every business and every person as well. So I don't think necessarily that this time is different just because the scope is different. But then what we should focus on is the central theme of what the role of the market is and what the market prices are telling us today.
Still to come, investing in a global equities fund means we're overweight on U.S. stocks and the dollar. That worked very well for years, but maybe no longer. Is U.S. exceptionalism dead? Why does that matter for our portfolios?
Money Hacks by the Business Times delivers useful financial tips every Monday. Subscribe to the playlists in Spotify, Apple Podcasts, or wherever you listen to podcasts. But if watching is your thing, we've got you covered. Subscribe to the Money Hacks playlist in the podcast tab of BT's YouTube channel and watch as Howie Lim gets the inside scoop on the best money hacks. Subscribe and watch today.
And now, back to WealthBT, a podcast of BT correspondents.
Welcome back. Wei, longer-term bonds have been sending a rather negative signal on markets. What do you think the bond market is telling us today?
I like that you're asking me what the market is telling us today, right? Supposedly about the future, not just looking at what happened in the past, because market prices are forward-looking, whether it's stocks or bonds. So if anything, if you think about bonds, when you have negative realized returns, prices go down, yields go up. But then on the going forward basis, that means higher expected returns on the going forward basis. So more broadly speaking, there is a lot of information about future expected returns in bond prices and yield curves that you can actually use in real time to position your portfolios for higher expected returns.
So we talked about the major patterns in financial market history. So for us as investors, what lessons can we draw?
I think over the long term, it's good to be reminded that on average, we've seen, say, equity markets realizing give or take 10% annualized return. So that means at that rate, you're doubling your money every 7 years. But then the way to get to that 10% annualized return is far from a straight line. we've seen many major bear and bull markets. We actually have some data showing that over the last 100 years, we've seen 18 bear markets defined as at least 20% fall from a previous peak. And then we've seen 19 bull markets. And then there, the advances range from 20% to more than 900%. And typically what you see is that the average length is actually shorter for bear markets, on average less than a year. But for bull markets, average 4.5 years. So in some sense, bulls run longer, have more stamina, if you will. But I think taken together, it's clear that in order to get that 10% on average, going through that ups and downs is part of the deal. And it also reminds us that in order to get there, you have to be very disciplined. And of course, discipline is the hard part. I also want to mention another analysis we did just showing how costly it is to miss just the best day or best week. So for that one, we looked at U.S. equity data from 2000, so about a quarter of a century of data. But then out of that 24, 25 years, if you only missed one best week, then your end wealth is down by more than 16%. And that's exactly what we saw last month, right? There was one day, mid-April, when the market was up almost 10% in one day. And 10%, that's the annualized return, but it's realized in one day. And in fact, the long-term equity return, a bulk of that is realized through those outsized daily returns. So that means if you had sold out of it and missed out on that rebound, it will be very, very difficult to catch up.
And yet, a lot of articles that I read said, don't buy the dip. What do you think of this?
To some extent, I agree that just because there is the past downturn, it's not predictive of the future returns. So I wouldn't say that returns will automatically be higher or lower based on the past performance. If anything, I think we think that expected returns should always be set to be positive. So if you had assets to invest, then you should already be invested instead of waiting for the dip to buy.
So many investors hold too much U.S. assets in the dollar just because they invested in a global ETF based on the world index. If U.S. exceptionalism is dead, what are the implications for long-term portfolios?
Yeah, I think it's interesting how narratives are changing very quickly, right?
Yes.
I think last time I remember we chatted about the outsized returns of U.S. market and everyone's missing out. Now we're talking about death of U.S. exceptionalism trade. In both cases, the implications for long-term investors are not that different. Just like last time I said, you need to look beyond the shiny stocks and beyond just the best performing market and be globally diversified. And I think now it's still important to be globally diversified and not to dump the entire country, right, just because of past performance. And interestingly, I think what happened with the U.S. stocks is not that different from what we have seen with any other individual market. There has been a lot of randomness. In fact, for example, if you look at 2024, the best performing market in developed markets was Singapore. But then the year before, it was third to last. And then just before that, it was in the middle of the pack, right? You really cannot predict country level performance. So I think it's better not to do any country bets and then to chase that recent performance. We still think that starting from market cap weighting is a good starting point, right? Going back to what I said about how market prices are constantly reflecting new information and changing expectations. And then by extension, the market weights of individual markets and individual stocks actually give you that instantaneous snapshot of basically diversification and trade-offs between risk and returns. So we think it's good to still start from that market cap weighting. Of course, then there can be sensible reasons to deviate from that. We see a lot of, for example, home bias and other reasons to deviate. But again, don't deviate or make country bets by looking at the real mirror and then chase past performance.
So here's the $1 million question. What should investors do? Should they be repositioning, for example?
In terms of their asset allocation, hopefully they've already set an asset allocation that allows them to go through the ups and downs, that already kind of take into account the potential movements in asset classes. I think that's kind of the whole goal of having that financial planning and asset allocation. If the recent market swings are telling them something different about their risk tolerance, right? Because sometimes you have to go through in order to realize what you can stick with. Then you should make those changes, but then that should be more of a permanent change. And then in the end, I think the right asset allocation, there's never one size fits all, which is also why we actually like to work with, say, financial advisors who understand individuals' circumstances and then to put together a proper financial planning plan. We often say that the most important part of that planning is plan for your plan not going according to plan. It's a mouthful, but kind of a lot of the uncertainty and the changes in the market, they shouldn't shake your own overall financial planning.
We've just heard from Dr. Wei Dai of Dimensional Fund Advisors. Thanks so much for dropping in.
Thank you for having me.
The truth is, no one can predict the future, especially in the short run. Every year, the smartest forecasters are proven wrong. But if you give it enough time, markets do go up eventually. As they say, diversification is the only free lunch. By combining assets that don't trend together in tandem, your portfolio can reap returns at a lower risk. I hope this episode will help you to stay the course and hold your nerve. BT Correspondents will be back next week with a new episode on transport, so do check it out. If you have any thoughts or questions about the show, email us at btpodcasts@sph.com.sg. I'm Genevieve Cua. As always, thank you for listening.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.